one of the things I always do come across is when people are discussing these different pension arrangements and the benefits that are available in them, defined benefit comes up a lot, right? For those that have been involved in one and have accumulated one over the years. But I really want to concentrate on passing this money on, right? And that's what today's session is around. So when I die and I have a DB pension, what does my wife typically get from that arrangement?
It's usually dependent on the individual scheme, but usually the most common pensions for a spouse that we would see is a 50% or 67% of what you would be receiving in your income stream. Okay,
and this question gets asked a lot, I think, and it's, is that then a sufficient, benefit from my next of kin or my spouse?
Well, I guess it's quite a subjective question, really. In some circumstances, that may be more than sufficient.
Yeah.
People might be living way beyond the means.
Yeah.
In a lot of circumstances, it's not sufficient.
Yeah.
But again, it's just all down on that individual basis.
So that question really is down to each individual, ultimately.
Exactly.
But the thing that concerns me then, Richard, is that when we're looking at that as a benefit to leave behind to my wife and my children, it's an income that is being paid out regardless. Mm-hmm. Is that right?
Yeah.
So my wife has no control on that income coming into her now tax bracket ultimately.
No, not at all.
So in reality, when we're talking about tax optimization and making sure that we're making the most with our assets and we're making sure that we're giving the most, and we're talking about wealth here, and I think that there's really two things to consider. There is wealth and then there is income, right? And we have to be clear, they can be two very separate things for a second, especially when we are talking about a defined benefit scheme. And there's been a lot of talk and hot topics around defined benefit schemes and actually transferring them and taking these CETVs that have been on offer over the last few years because the rates have been so low on interest, etc., and gilt rates, etc. So if I'm now asking my wife to take an income, that's also got pros and cons to it, right? If she's got a job, for example, and now she's being given an income that was 50% of what I had, that's not tax efficient at all, is it?
No, definitely not. And as you say, if she was working and for the next 10 years, for example, there's no sort of way for her to then stockpile that income or save that income for a later date. So
she literally has no flexibility with that money, and it's therefore, and again, I think this is the key one with a defined benefit and how it differs from a defined contribution scheme, is that it isn't a pot of money. It is purely an income stream that's been turned on when I told it to be turned on, or when I was being told it had to be turned on. Because these schemes, they actually dictate to us, don't they? Rather than the other way around. So that isn't, that's not a favourable way. But it's not to say that you should then go and transfer every DB scheme.
No, definitely not.
And what reasons would you not want to be transferring DB schemes?
Well, DB schemes are a valuable asset, and as I say, they're an income stream for life. And this will pay out all the way up until the day you die. So you've never got that worry of potentially running out of money.
Which I think is really important as well.
Exactly.
Right? And I think that's where a lot of the time, certainly governments today are taking a big view on this, because without those types of solutions in place and, ultimately an income for life, then if that isn't there, unfortunately it defaults to, governments to have to look after people moving forward. So, and again, this is why it's been quite contentious over the years, but there certainly are. You can certainly start to see pros and cons for having a defined benefit scheme and looking at how to then pass wealth on from the defined benefit schemes. And that's when you then having to go back to these CETVs or these cash equivalent transfer values and understand what value you're getting and being offered today in order to replace that income in the future, and how much of that income you're going to be using. Because if, let's go back to that scenario where my wife is working and I die and, she then starts to get 50% of my income and she's still working at that point in time, she's paying more tax than she needs. And you're right, she's not being allowed to stockpile that money for later on in her life either. right? So she's limiting her own opportunity for what she wants to do, and she's actually possibly reducing some of the choices that she could have later on in life because she's got this income without necessarily wanting it, you know. So, like you said, I think it is a bit of a subjective question on whether or not those benefits are sufficient, but there's a discussion to be had behind it or around it as to whether or not it's the right solution for the family. And I think the last thing to add on to that is that what's the typical arrangement for children then in terms of DB benefits?
So a lot of schemes won't pay out any benefits to children at
Right.
all. But the ones that do, usually you can see something like a 20% pension.
Okay.
But that will only get paid out up until the child's finished with full-time education.
Okay.
So in a lot of circumstances, you know, people's children, when they've passed away,
Yeah.
are actually much older than that, so they
Yeah.
won't receive anything from it at all.
Okay, so moving on then in terms of looking at transferring wealth and succession planning and leaving a legacy for the loved ones behind, if we go back to the four kind of structures that we have, what sort of implications do we have when it comes to inheritance tax then? You know, let's start with DB. We've just covered a lot of the DB stuff. So am I on the hook for inheritance tax if I have a defined benefit scheme?
No, so that income stream will not be included in any inheritance tax liability calculations at all.
Right, and that's because my wife is then paying income tax on it.
It's just because of pension in general.
Right.
Pensions aren't liable for inheritance tax.
Okay, so that's quite interesting. So on a DB pension, I haven't got any worry on that future income going to others when it comes to inheritance tax. Yes, there's marginal income rates that my wife needs to consider. So let's look at a defined contribution scheme, you know, where I've got this pot of money that's built up with my employer. And the defined contribution scheme is ultimately then very similar to a SIP, and I think in this case a QOPS when it comes to inheritance tax. So what are the implications on me with a DC or a SIP?
So there aren't any, as I say. With it being a pension, there's no inheritance tax liability at all. It's
Okay.
one of the great benefits of actually having a pension.
Right,
It's a
okay.
really good tax wrapper.
Okay, so actually when it comes to financial planning then, these structures, when we're talking about retirement schemes or structures or whatever we want to call these things, is that if we've got concerns over inheritance tax, we really want to try to be keeping hold of these things.
Yeah, no, exactly.
Okay.
So, I mean, obviously the inheritance tax nil rate band in the UK at the moment, £325,000.
Yeah.
It's not much. Between husband and wife, you know, it's going to be £650,000.
Yeah.
So
You've got some other allowances around those things like main residence, etc. But no, you're right. And hopefully, you know, you kind of get up to the million mark by that point. But this now is a vehicle, you know, these pension vehicles are then good, solid vehicles to ensure that we can pass wealth on successfully, you know, and tax efficiently. So that they are, for the purpose of today, tax optimized, if we like. Yeah.